Hey everyone, welcome back to Corporate Decoder, where we unravel the mysteries of the corporate world. Today, we're diving deep into First-Hand Technology Value Fund's latest quarterly report, and let's just say it is a bit of a roller coaster. Stick around, because this report has some eye-opening numbers and a story that is definitely worth decoding. And hey, before we jump in, if you love getting straightforward insights from financial documents like this, make sure you are subscribed. We also have a fantastic community growing on Discord, link in the description. Alright, let's get straight to it. This is First-Hand Technology Value Fund Incorporated's quarterly report covering the period up to the 30th of September 2025. First up, let's look at their assets and liabilities. As of the 30th of September 2025, their total assets were about $811,382. This is a pretty significant drop from the 31st of December 2024, when their assets were around $1,795,613. That is more than a $500,000 decrease in assets in just 9 months. Their liabilities also came down from $734,934 to $514,835. But even with liabilities shrinking, the asset reduction is the biggest story here. This brings us to the net asset value per S-hair. On the 30th of September 2025, it stood at just $0.04. Back on the 31st of December 2024, it was $0.15. That is a roughly 73% drop in the value per S-hair. Imagine if you owned shares back in December. Their value has nearly evaporated by September. Now let's look at how they've been performing their income and expenses. For the 3 months ending the 30th of September 2025, their total investment income was a meager $2,314. That's compared to $35,792 in the same period last year. A huge drop in income, but here is where it gets interesting. Their total expenses for those 3 months were $432,943. Even though their income plummeted, their expenses remained substantial. This is a recipe for losing money. This resulted in a net investment loss of $430,629 for the 3 months ending the 30th of September 2025. This means they are spending much more than they are earning. And if we look at their investments, they chalked up a loss of $20,083 from unrealized depreciation in that same 3-month period. Now let's zoom out to the 9 months ending the 30th of September 2025. Their investment income was $179,140. While that sounds better than the 3-month period, remember it was $97,793 in the same 9 months of the previous year. So it did actually increase. However, their total gross expenses for these 9 months were $786,161. This is significantly higher than the $2,182,907 figure for the 9 months ending the 30th of September 2024. Now, this big difference is largely due to a massive fee waiver in 2024, which we'll touch on later. Without that waiver, expenses are actually growing. This brings their net investment loss for the 9-month period to a hefty $607,021. And on the investment side for those 9 months, they saw a net realized loss of over $24 million and another unrealized loss of about $1.5 million. That is a substantial hit to their portfolio. Let's dive into their investments. This is where the core of their business lies, and frankly, it is quite a mixed bag, with many of them marked as restricted or controlled investments. A huge chunk of their portfolio value, about 57.8%, is tied up in UCT Coatings Incorporated. But here is the kicker, its value is listed as only $171,528. That is a very small value compared to its proportion, indicating it might be a deeply troubled investment. Then we have EQX Capital Incorporated, making up 7.8% of their net assets, valued at $23,173. This appears to be a preferred stock investment. And Interrupt Medical Corporation, a medical devices company, represents a smaller 1.1% with a value of just $3,224. Overall, their total net assets as of the 30th of September 2025 are a mere $296,547. This is a stark contrast to the $1,060,679 in net assets they had at the end of 2024. A massive decline, in short. Looking at their share structure, they have 6,893,056 shares of common stock outstanding, but the net asset value per S-hair is only $0.04. This means that these shares, which represent ownership in a company with over $91 million in investment cost, are trading at an incredibly low valuation. Now, let's get into management's perspective on their financial health. The report highlights a significant shift in their portfolio, while at the end of 2024, around 70.3% of their investments were in exchange, traded or money market funds. That figure has dropped drastically to 19.9% by the 30th of September 2025. This suggests they've been moving out of safer, liquid assets and into more concentrated, potentially riskier investments. Conversely, their advanced materials sector, which we saw dominated by UCT Coatings, has surged from 24.5% to a whopping 57.8% of their portfolio. This heavy concentration in one sector, especially one with such a small reported value, is a major red flag. Let's break down the results. The 3 months ending the 30th of September 2025 show a continuation of the financial strain. Investment income has fallen dramatically while expenses remain high, leading to a significant net investment loss. The unrealized losses on their investments further compound this negative picture. For the 9 months ending the 30th of September 2025, the story is similar with substantial realized losses from selling investments and ongoing declines in the value of their holdings. The net result is a significant decrease in net assets. Turning to liabilities and looking back at the consolidated statement of assets and liabilities, we see items like payable to affiliates and deferred directors' fees payable. These are standard, but their scale in relation to the company's overall assets is worth noting. The company invests heavily in private illiquid companies. Valuing these is tricky, and they rely on fair value determined by their board of directors rather than readily available market prices. This is where things get really uncertain. Their level 3 investments, those valued using unobservable inputs, are substantial. For example, their direct venture capital investments in advanced materials are valued using revenue multiples and discounts for lack of marketability, and for medical devices, they use revenue multiples, volatility, risk-free rates, and something called going concern probability. This tells us these valuations are highly subjective and based on estimations that could be way off. The reconciliation of level 3 assets shows a massive unrealized depreciation of over $88,000 in the advanced materials sector. This is a significant markdown on an already heavily weighted investment. Looking at specific companies, Intraop Medical Corporation has multiple convertible notes, but their reported value is only $3,224 for September 2025. This suggests a significant write-down from their original cost basis. The management agreement with First Hand Capital Management Incorporated, or FCM, their advisor, has been approved for another year. However, this section is fascinating because it details the company's very difficult financial situation. It mentions substantial setbacks with Intraop and Rightspeed, leading to write-downs of most or all of their value. Revasum also failed, with its assets foreclosed upon. This whole section is a deep dive into the struggles. The board acknowledges that the net asset value has fallen significantly while the stock price has also declined, though less sharply. They attribute this primarily to the failures of key portfolio companies. Interestingly, the report discusses how the advisor has waived management fees for years and even paid some company expenses out of pocket. This indicates the company has been bleeding cash. Despite this, the report states that the advisory fee structure is comparable to peers, which seems questionable given the company's performance. The profitability analysis suggests the advisor's profits are not excessive, given the dire financial state of First Hand Technology Value Fund. Incorporated, one has to wonder what excessive would even look like here. And finally, the legal side, there are 2 major lawsuits detailed. One filed by Star Equity Fund LP alleging violations of federal securities laws related to asset valuation and breaches of fiduciary duty. The other by Vested Cap LLC against Intraop Medical Corporation and Kevin Landis. Now, also naming First Hand Technology Value Fund, incorporated as a defendant, with claims including wire fraud and violations of the RICO Act. The company believes these allegations lack merit, but the defense costs could be significant and impact their financial condition. So, what's the verdict on First Hand Technology Value Fund? Incorporated, this report paints a picture of a company in severe financial distress. The massive drop in asset value and net asset value per S-hair, coupled with significant investment losses and high expenses, paints a grim picture. Their heavy concentration in seemingly impaired or illiquid assets, particularly UCT Coatings Inc., presents a huge risk. While the management compensation and fee structure are being scrutinized against industry peers, the underlying business is clearly struggling immensely. The ongoing legal battles add another layer of significant financial and operational uncertainty. This is a company that has seen its net asset value decline by over 73% in less than a year, and it faces serious questions about its future direction and viability. Alright, that is our deep dive into First Hand Technology Value. Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps get these breakdowns to more people, and make sure you are subscribed for more in-depth corporate dissections. And don't forget to join our Discord community, linked in the description, where we discuss these filings and more. Thanks for watching, see you next time.